Now the part of the show where we talk about three things that I think are extremely important for individual investors to focus on before you make your investment decisions. And the first topic, I guess, is, as we have a lot this part of the show, is economic data. But I wanted to focus on one particular data point, and that is all eyes on upcoming U.S. jobs numbers. The United States will report jobs growth coming for the month of September, coming this Friday. Canadian jobs numbers will not be reported until the following Friday. I believe that's October the 11th. So all eyes will be on what that report is. Will we continue to see jobs growth? Will we continue to see revisions to previous numbers, downward revisions as we've seen in the past? What are those jobs numbers going to look like? Second idea or topic, market volatility. I think that right now there are three things that are causing market a little bit of anxiety and could bring some volatility in the next 30 to 60 days. We'll talk about that shortly. And our third point, third quarter earnings. And that's, as I just mentioned, I think that could be the next catalyst, hopefully the next catalyst for the markets when third quarter earnings kick off in a couple of weeks when big banks report. We'll also see names like Delta Airlines report. We just received some reports, one from Nike yesterday. And so quarterly earnings are just starting out, and we'll get into full swing in a couple of weeks. So let's talk about our first point, all eyes on the upcoming U.S. jobs numbers. And let's go to our first chart, a chart we've seen already, monthly job creation in the U.S. This is, there you have it, 142,000 jobs created. And that was a lot better than expectations. And you can see from the 3 months prior, a nice downward slope in job creation. And that was due to some revisions. We had revisions in July numbers, revisions in June numbers. Numbers were over 200,000, came down below 200,000. And, there's talk that perhaps we could see a revision to the August numbers as well. So we'll have to see if that comes in. But I think the expectation for September numbers just above 100,000 jobs created. So if we do get that, it would be that Goldilocks scenario, right? Not too hot, not too cold, not too hot for jobs growth, which would influence or perhaps make us concerned about inflation again, but also not too cold, not too low of a jobs number, because that would mean maybe the U.S. is not faring as well as we are hoping. So that is something we will be looking at come Friday morning at 8:30 Eastern time. U.S. unemployment rate, our next chart. You can see here that, and this number is given to us when the jobs number is reported as well. And you can see a gradual upward trend. August, we're seeing now 4.5% unemployment rate, definitely a lot higher than where we were, or where the U.S. was, I should say, which was below 3.5% back in 2023. And I guess the Fed now talking a lot more about jobs, job creation, and unemployment. That seems to be taking center stage versus the inflation fears that we've been focusing on for the last few years. So I think that's why the Fed has changed now from interest rate increases, which we saw many of, as many, I believe, as 11 over the last couple of years, 2022 and 23, to now the Fed cutting rates. And we saw a 50 basis point cut this past month in September. So keep an eye on the unemployment rate and what they say about the unemployment rate on Friday. And our third chart or last chart for this idea is the job openings. And we just received, we call it JOLTS. Job openings and labor turnover is what JOLTS stands for. And again, job openings, a steady decline in job openings. Again, the Fed wanted to see a decline in job openings, but they're keeping an eye on it now, even though we saw a bit of a tick up in job openings this past reading, which was in the last day or so. Overall, job openings has been coming down. So if we get too weak of a number for jobs on Friday, this definitely can be a market mover and something that I think individual investors want to keep an eye on. Our second point, market volatility. And as I said just a moment ago, where can market volatility come from? I'm sure many of you watching today probably could guess what's going to cause market volatility, but I have three ideas. Number one is the Federal Reserve. And we know that the Federal Reserve right now is starting to decrease rates? Well, I think there was a survey done recently by the National Association for Business Economics, and they found that 39% of economic forecasts fear that the Fed would be too slow in cutting rates. We have our first chart, which we can show on the Fed and the Fed funds rate. You can see there that, yes, rates increased 11 times in 2 years, and then they pretty much stayed flat for quite a bit of time. And many believe that the Fed should have started cutting in July of this year or even earlier, and they didn't cut until September. And I think the 50 basis points may have been a catch-up rate cut because the Fed believes maybe had they had some of the economic data they saw recently, they would have cut sooner. But 39% surveyed believe that the number one issue or problem that we could face to cause volatility will be the Fed going too soon to cut rates. Second thing, actually, is 23% of those surveyed believe that the U.S. election could be the issue or the event to cause volatility in this market. And another 23% felt that the geopolitical events around the world, what's going on in the Middle East, Ukraine, they could present some volatility and downside risk to the economy. So interesting survey. Even though over the last 24 hours, I think a lot of eyes have been on the Middle East, the Federal Reserve is still the number one point that individual investors and this survey, economic forecasts, almost 40% of those forecasts believe that the Fed could cause the volatility. Another chart that we have here, the next one, and you can see what I was saying about 50 basis point cut by the Fed. And then right away followed by, or earlier in 2022 and 23, 11, count them, 11 rate increases. If the Federal Reserve all of a sudden starts to cut rates very quickly, I think they're going to get a lot of questions, just like I said on the radio show that I had this past Sunday. You know, when the Bank of Canada is now perhaps cutting interest rates aggressively, one could ask, maybe the Fed raised rates too quickly or too much, because now they seem to be cutting rates very quickly. So will their credibility be called into question? And yeah, our last chart for this part of this segment is the CBOE Volatility Index. And we can see here that the index has spiked up a couple of times in August, a little bit in September as well. And again, this is on, a lot of this has to do with interest rates. And as I said earlier, some fears about what's happening with the election. In election year, markets do well, but the candidates have said, one candidate is saying, former President Trump, talking about tariffs. Tariffs are like taxes on individuals. I know the Trump administration didn't believe that when they put the tariffs on when they were in power. And then you have Kamala Harris, current vice president of the United States, talking about if she becomes the next president, she's going to raise taxes. So that could be obviously the cause of volatility. And lastly, as I mentioned, we have the potential for an escalation in the war in the Middle East. We're seeing a lot of events take place daily, hourly, and unfortunately, that is the case. And what could that bring? Could that cause the price of oil to spike? And if the price of oil does spike, could that cause inflation to move higher? And if the United States is, comes into this conflict, what does that mean for the United States and the economy? What does that mean for the economy in North America and around the world? So market volatility, something for individual investors to focus on. The third point that I said as part of my 3 for this show is third quarter earnings. And we're going to get third quarter earnings kicking off. We call it the kickoff to earnings season starts with the banks. And our banks are in Canada, obviously give us the pulse of how the economy is doing, pulse of the nation, pulse of the country. And the same would go for the U.S. banks, the big money center banks, J.P. Morgan's, Wells Fargo's, Citigroup, Bank of America. They're all going to report earnings in a few weeks. And what are they saying about the economy? Is it continuing to slow in the United States? Is it slowing at a measured pace? Or is that slowdown quickening? And we're all going to be listening to see what the biggest bank, J.P. Morgan, says. They are the biggest bank in North America and one of the biggest and best run banks in the world today. We have a chart of the big banks or of the banking index. We can show here in the US, you can see how well the banks have done with this idea of rate cuts. We've seen 50 basis points. We were hearing about rate cuts even before Fed started cutting rates. And I think that has been a good thing for the banks, even though JP Morgan has said their net interest margins have, they don't predict they will be as high. So that part of their income and revenue won't be as high. And I think that has to do a little bit with interest rates coming down. But overall, I think with interest rates coming down, that has helped some of the big banks, I guess, spur on more activity, more borrowing, businesses borrowing, and individuals borrowing perhaps to buy a house or other big ticket items. A couple of charts here on individual banks, JP Morgan, that we will show. I've shown a chart of JP Morgan many times on this show. Look how well it has done, just off its all-time highs. I believe it's gotten up to, as you can see here, a chart over $225 a share. I think it reached at 1.227. Not that expensive, still relatively cheap, trading at maybe 11, 12 times earnings, 11 times forward earnings. Wells Fargo, our next chart, another one of the US's top big banks. I would say they're the third largest bank in the US right now, with Citibank right behind them. And Wells Fargo, not as international as a name like Citi, but you can see the chart of Wells Fargo, and it's sort of flat, right? Up and down, up and down. Really hasn't gone anywhere since it reached its highs back at beginning or end of July, beginning of August. It's come down a little bit since then. So let's hear what these banks have to say. I think third quarter earnings will be very, very important for the markets. The banks will be very important for what we think is going to come later on. Obviously, tech earnings, all the different sectors will be reporting one after the next. But I think third quarter earnings is something we need to focus on, along with some of the market volatility, US election, and of course, what the Federal Reserve is going to do and what they're going to say over the next few quarters.